everyone, and thank you so much for joining us today. I'm your host, Shireen Benzayed, Head of Innovation at Finastra, and we are welcoming you for this live meetup, which is one of a series, part of our Hack to the Future Global FinTech Hackathon. Hack to the Future is a FinTech movement igniting a world of financial sustainability, inclusion, and empowerment. And building on the success of our previous hackathons to redefine finance for good and build an unbiased fintech future, we continue to use our position in the market to inspire the fintech space to be open by default for everyone. And this year, we aim to drive engagement beyond our global fintech ecosystem with three key themes that are first one, sustainable and inclusive finance. Second one, embedded finance and banking as a service. And third one, decentralized finance. And we've actually entered the last week of the hackathon. So you've got till the 10th of April to register for the hackathon and to submit your idea or your project. And you can find more information about Hack to the Future 4 on fintech.devpost.com. Now, today we'll be talking about theme 3 of the hackathon with decentralized finance, digital assets, digital currencies. And I'm really excited to be joined here by Dan and Jehangir from Lloyds Banking Group. Hello, everyone.
Good morning.
Good morning.
Hey. Thank you so much for joining us today. I'm really excited for today's session. And before we get started, do you mind maybe introducing yourselves to our audience?
Yeah, I'm just going to quickly share my screen just so we can you can see our faces already, but you can see our non-moving faces on our presentation.
It's all right. Whilst you're doing that, I can kick off. That's fine. So, morning, everyone. I'm Jehangir. I'm the emerging technology lead at Lloyds Banking Group. My background is in engineering. I was sponsored through my degree by the Ministry of Defence, but I ditched that work pretty quickly and moved into strategy consulting, both in-house and in consultancy, and then moved into innovation in 2014, looking at how we can embrace fintech in banking. And then since last year, I've set up a emerging technology team looking at everything from blockchain through to IoT, connected devices, machine-to-machine identities and soft identities. So a range of topics that our customers and clients are already adopting, and that may prove quite useful in our own proposition design. Dan.
Cool, thank you. Hi, I'm Dan. Nice to meet everybody. I have been at Lloyds since 2015. That was actually the year I graduated, so I joined on the graduate program in commercial banking. So it covered roles such as relationship management, as well as back office and credit type roles, before moving into small business banking, looking at our strategy and proposition development, which is where I first came across Jehangir in the bank. I've since moved into digital currencies now as a senior manager, looking at strategic partnerships that we'll be looking to implement in the next year or so with Lloyds and other banks. Also looking at other use cases within DLT, which we can talk about later, as well as providing some thought leadership and some general storytelling around blockchain for the bank, how it can be used and what it may look like in the future. So thank you, Shireen. Should we move into just a little bit about ourselves and how we operate as a bank?
Yeah, absolutely. Let's get started.
Brilliant. So Jehangir, I think you were going to open about how we innovate at Lloyds.
I was on mute. Classic mistake. So we follow a pretty standard innovation pipeline where we first look to identify opportunities, which we do through sensing and scanning and looking for weak signals in the marketplace. We then try and assess those with relevant use cases for our customers and clients. So as Lloyds, we operate both in the retail space for consumers through to small businesses and large corporates, as well as having an insurance division. So there's actually, we're quite unique in that sense in the UK with that bancassurance model. And therefore, we actually have quite a broad portfolio set. So we're interested in quite a range of use cases. And for those that we find most engaging, we often look for some product market fit. And where our interest is most strong is in the opportunities that can drive more transformative changes to our revenue streams and business models. So some of you may have come across the 3 Horizon model from McKinsey, or the sort of very similar model at sort of Harvard, where they talk about incrementing at the core, at the adjacency, and then in a more transformative way. So we tend to focus on those latter 2 as a central team, allowing our divisions and their change and business teams to really focus on that Horizon 1 and sometimes into Horizon 2. And we'll also look to support them there. And we've had some successes in this space, some quite closely related to the work that Dan's been involved in, which is really taking the work almost through the whole funnel to live products with customers. So Dan, do you want to give us an example?
Yeah, it's a great example to talk about. It's something called the Business Financial Assistant, which was a retail business banking proposition, which is an accounting package and tool for small businesses to use. I think it's a great example of how we spotted an identification area, which was that often the ecosystem really is quite pervasive in the small business landscape, that their accounting and their business account can be connected together to give them better experiences, to let us understand the customers more by seeing what's happening in their books, and to smoothen the overall relationship experience with the bank. So Jehangir's team really started looking in this identification stage at accounting platforms and packages and what's happening in the market, looking at assessing vendors and working with one directly before we brought it into the business. And we tested it via proof of concepts and understanding what customers liked, what they didn't quite like about it, before launching it as a fully fledged product, which is now a paid offering. It's on our website. If anyone is interested, it's called the Business Financial Assistant. You can find it on the small banking business section of our website. But it's a great example how we went from identification of almost a gap that we don't have in our proposition set today, to then assessing vendors, assessing capabilities, what they might build for us, and then bringing it into the business and becoming a fully fledged product, which is now managed by the team that I'd be previously working in.
Yeah, perfect. And that's really an example of how we try and drive that innovation, both initially from our sort of center of excellence, but then make sure it lands with real results with customers and colleagues. In terms of where my team's interest is at the moment, it's across these 3 key domains. So Web3 and the metaverse is clearly a really hot topic at the moment. And for us, it's about that fluid experience across both the real and virtual. And importantly, it's not just where you hang out to have fun, it's where you can live and work and earn, as well as potentially spend. And so we're interested in a range of topics there. You know, we're going to cover some elements of digital currencies later today, but there's some really other interesting Web3 concepts around how do you organize organizations, communities, potentially companies, and even countries. And we're also thoughtful about how, and you can see it already in the way some industries like manufacturing are adopting some of these mixed and extended reality technologies. Alongside that, we're interested in the fact that machines are becoming increasingly intelligent, and they're powered by AI. They've got their own agency, and they're unlocking the ability to both model, measure, and control the real world, and assisting us in new and novel ways. There's another part of the team that sort of looks at sustainability and society of the future, and they've been looking at things like electric vehicles and the electrification of transport, and they've therefore been looking a bit at the autonomous vehicle side. But in terms of other devices and wearables and IoT, we're very interested in that. Again, if you look at what's going on with connected factories, let alone what's going on in your home with smart devices, there's a huge adoption by customers across the group, and so we're quite thoughtful about that. And then data underpins both of those 2 before it. And if you think about it, you know, the younger generation, they're more worried about losing their Instagram profile than they are about losing their passport. So, these days your soft identity is as important to you as your, government issued hard identities. As you look to work with more and more partners and third parties in a bigger ecosystem, the ideas of zero knowledge proof, or how do I operate in these more trust minimized ways, becomes ever more important. And of course, that trust minimization again plays back into some of the capabilities that people are exploring with blockchain. And then, if I'm looking to model the real world, how can I do that in an ever better way? So digital twins, again, is something that we find quite interesting. Clearly, banks have often modeled both people and corporates through a lens of credit risk. So we've done some modeling for a very long time, but I think we can have a far broader sense of what's going on in these digital models going forward.
So, so as we move through this presentation, we'll be focusing, of course, on blockchain. We're going to quickly recap just an overview of what blockchain is. We think there's a few varying definitions. It will then move into the overview of money today and how we've seen an evolution, which again we'll elaborate further on as we go through the pack, and how this has led to the future of money that some talk about with CBDCs, central bank digital currencies, which is very much on your retail side. Before we'll move into some banking use cases, which are covering both wholesale and further use cases within retail banking from a private limited company's perspective, from a banking point of view. But let's just move into just a quick recap of what is blockchain. Jehangir and I will just go through some of these, and we're going to start counterclockwise. So we're going to start with revolutionists, where we really think this came about, where we see blockchain starting as this peer-to-peer network, which is a way of sending payments between one another, which was really the concept of the Bitcoin 2008 white paper. But it's built on that over the last few years as they've taken this principle of decentralization and built on top of it, whether it be decentralized finance or DAOs, to name a few in the currency side of things. But you're also seeing growth in other areas as well, like music. Music's a good example of where they've taken the principle of blockchain and using things such as NFTs to really explore how they can radically reshape society or challenge the paradigms that we have today. We're going to stay pretty close towards businesses, though, and organizations for this presentation. And when we look at blockchain there, we see it as a distributed ledger amongst the industry. And it's shared between participants, but at the moment, it's still in exploratory stages. You can see good examples of blockchain existing already in things like supply chain management. For organizations like Walmart, you're seeing good examples today where they're using the features of blockchain with this kind of this viewable ledger they can see across their supply chain. So you might see examples of when they're looking at meat contamination in a certain store, they can track it all the way back to the lights have gone out in this room. Sorry. I'm just going to move around as I speak, otherwise I'll be presenting in darkness. But I'll just carry on. I think I might be presenting in the dark for a little bit here. But as we use these examples as well within businesses and organizations, where we're seeing large institutions within financial services coming out to explore the concept of DLT and what the technology can offer them. It can start digitizing processes that we use today, whether it be sort of manual back-end work that exists within financial services. We're seeing use cases that can develop that, or indeed enhance the features or unlock new capabilities of products that we have today using DLT. And I'm just going to move on to engineers and developers and pass over to Jehangir and just try and get the lights on in this room.
Yeah, you try and get the lights on. I mean, so we've heard there about the revolutionists, the anti-establishment libertarians who absolutely thought of Bitcoin being a new world order. We heard equally about how businesses are thinking about things potentially back to front, calling it DLT, starting up these private blockchains. EY had a paper that said, on average, private blockchains only have 1.5 nodes. And given you need a founding member, that means on average, 50% of these private blockchains didn't have another node. So some interesting things going on the right. I think what's really interesting is what's on the left, for me at least. So, we've had in recent years, especially through the explosion of what Solidity brought to the table with inside the Ethereum virtual machine, this whole idea of smart contracts. So the idea of being able to have computer code and business logic embedded on these distributed networks. So you're seeing a lot of protocols starting to action what was previously activities done by, say, companies. So if you look in decentralized finance and DeFi, you've seen a range of protocols that have embedded what would have been previously done by a stock exchange, by a building society for savings and lending, etc. And I think it's becoming a really interesting way of thinking about problem solving. And what we're starting to see with that through terms like Web3 is actually, what can this mean as I think through the future of not just the internet, but therefore the way that people and organizations interact and conduct business. So how do I actually start to think about potentially, so often when people use the phrase Web3, they talk about the internet of value. So how do I have information and value essentially flowing across the same types of digital rails, where at the moment they're on very different rails? And in doing that, can I start to understand where I can bring back some greater sense of competition? Can I remove some of the centralization that's occurred? Can I bring back some decentralization that people have felt has become a bit too centralized through an advertising powered internet that certainly consumers interact with today? So there are quite a few different ways that you can view this underlying set of technologies. And really, blockchain is an umbrella term. Yeah, people are interested in tokenization. They're interested in aspects of how do I balance transparency with privacy? How do I get data off-chain to on-chain with oracles? So there are a range of technologies that are really underpinned by that term. And I think each of those brings with it an interesting set of impacts and implications that are worth exploring. And we'll talk about some of these as we move through.
So we're just going to recap, just an overview.
Maybe before moving to the next part, Dan and Jehangir, I found this intro that you've just gone through really interesting about blockchain and how it is not just a technology, but also changing the way we operate and bringing decentralization, and I'm sure we'll go through some more specific use cases later. Just before moving on, I wanted actually to get your thoughts on public versus private blockchain, as this is a sort of an evolution that we saw in the market, but I wanted to hear really from you, your thoughts there.
Yeah, I mean, so you'll see a lot of private blockchains providing capability that looks a bit different to the capability that a public blockchain brings. So often you'll see that private blockchains will be used for the purposes of synchronization between known parties, which is quite different to the trustless or trust minimizing rationale that's often used for the more public blockchains. So if you're trying to build bigger ecosystems with more participants, then it can be really important to think about where a public blockchain fits in, where actually you're just trying to create greater efficiency among your existing set of stakeholders. Then there can be huge benefits, partly at a cost and just in itself its own efficiency of a private blockchain. So actually you're kind of using a similar technology set. That there are differences, as we were sort of saying, not least in consensus models and things like that. But you're using a similar sort of technology set, but you're solving very different types of pain points.
I think just to add to that as well, one of the interesting things with considering public and private, particularly in use cases for banks and for businesses, is also the consensus model that Jehangir mentioned, whether it's proof of work versus proof of stake, because it's an interesting concept to think about when we think about the era now of ESG and carbon emissions, particularly with large organizations like Lloyds Banking Group, who possess a significant amount of data in the UK's economy. So if we were considering, using blockchain for large use cases and things with that nature at Lloyds, that there could be negative or real kind of issues when you think about the amount that blockchain might use in terms of energy consumption. So I think with private blockchains as well, you can limit that because you can remove some of the issues around security that public blockchains might have, or concerns that regulators may have that private blockchains could offer. So there could be, I guess, wider thoughts there as we emerge into this era of net neutral and thinking about reducing carbon and electric emissions. So just something to bear in mind.
Yeah, absolutely. Thank you so much. That's definitely a very important point. Cool. Cool. So over to you. Looking forward to the next part of the presentation.
So Jehangir and I thought it'd be...
Is that back to me? I think we're going to do a little double act around the
yes,
around the money. Yeah. So this is just really a quick recap before Dan takes us through the sort of new information. Certainly new to me. I found it really interesting as he was walking me through it. So as we all know, if I'm trying to do any sort of record keeping, I'm recording a ledger. I need some units for this ledger, right? I'm not counting apples, so I'm only going to talk about pounds or dollars or euros. I need some sort of unit of account. And when I want to buy things in a shop, I don't want to barter. I don't want to exchange apples for oranges, or much more complicated. How many houses does it take to buy a shoe? Probably a fraction. So to avoid all that, I like it as a medium of exchange. And then hopefully, if I stick £50 in my drawer tonight, I'm hoping it's going to buy roughly the same amount of goods tomorrow as it did today. So it's a store of value. So these are the three most common sort of lenses through which we sort of analyze whether something is a useful currency.
I think it's just worth calling out a little point at the bottom as well, that we think about the amount of money that is now held electronically in this concept of digital money, bank deposits now all being electronic. 96% of that is now online. Actual physical money in the form of cash, your banknotes and coins, it's down at about 4%, according to the Bank of England in 2020. But when we just recap, so Jehangir's made a few points there about what we use money for and its use cases for us. But the real characteristics of that physical money is it's peer-to-peer. You use it without needing an intermediary, and there's no risk of double spend. But when you go into this electronic money concept, there is a risk of double spend, that people can duplicate or falsify money. It does require a bookkeeper, and it needs to be regulated and licensed. You have a whole plethora of regulation that exists within various economies of central banks setting regulations and rules. But I think the important thing to call out is just that right-hand side, that you see the liability concept of it in existence, that even on a crisp £10 note, or plastic note in this case, is you see the words, "I promise to pay the bearer on demand the sum of." So you're using it there in the form of a liability, that you owe something to somebody. Today, we'll recap just about how things work typically in this correspondent banking model. We use the term nostro and vostro, which is Latin for them and us, because we typically will have an account with them and they'll have an account with us. When we think about sending money overseas, you might have a bank like Lloyds, where they have customers that are wishing to pay and send money to suppliers overseas. Lloyds is a UK bank. It needs to have a relationship in America. It needs to have a relationship in Australia to fulfill those payments for its own clients. So in the correspondent banking model today, you would have an account with another bank. So you'd be then, if your customer is instructing you to make a payment like this, you'd be seeing a movement from one bank to another in terms of the assets and liabilities. So I think an important thing to call out here is that we have a recording of assets and liabilities, debits and credits that are moving between different banks. And that is how we typically will fulfill payments in a correspondent banking model today. But there's some limitations to call out, if you can see them at the bottom. There's things around trapped liquidity. There's also the credit risk that we have, and the KYC that exists today as well. Because if I have a client that wants to send money to Australia, you've got time zones and issues to go through where the market might not be open until tomorrow. So there's a delay of T+1, as we'd call it, that is 1 day post the transaction to take to fulfill it. There's also credit risk that exists. So we have to hold capital against other banks by the way that we treat risk and manage risk as banks. we are forced to comply with regulations and hold credit against different entities and different banks. And also when we go through these processes, there's KYC and due diligence that other banks will need to complete and fulfill along the way. So as a result, we have this correspondent banking model that exists today, but it has a number of limitations. We therefore use a real-time gross settlement type model, which is a central ledger. We all use something called SWIFT to make payments and use to send messages. You might have seen SWIFT on the news recently with Russia in terms of banning Russian accounts, because again, we're using a centralized model here. So in this instance, all of the banks on the right-hand side, they all hold reserves with the central bank, who marks them as liabilities. And this is an interesting concept that we'll segue into in a few slides' time when we think of what's happening in terms of innovation in this space. But today, we use a concept called real-time gross settlement in the UK, RTGS, which allows people to fulfill things real-time and gross. And as a result, by using something like this RTGS model, you reduce settlement risk because you're relying on a central model to fulfill and complete this for you, rather than having to commit and settle between different banks. So we use an intermediary to help make all of these payments and fulfill these settlements that are happening between banks. I think Jehangir and I just want to move on to an evolution of money.
Happy to. So, I think we've already talked about how for centuries it was the predominant form. It started to diminish. Cash was, it says central bank there. Let's think about cash for a second in particular, as a form of payment that people were using. Much smaller role now, as Dan was talking about. So the predominant form is commercial bank money that Lloyds or Halifax or Bank of Scotland create, often at the point where a customer asks for a loan. So this whole idea of fractional reserve banking, the money, people talk about coming out of nowhere. Not quite like that, but it is essentially created at the point, the money's drawn down. What's really interesting is what we're starting to see on the right-hand side of this page. Whether or not these things are actually currencies, or as some regulators like to use, crypto assets or whatever, there's some really interesting properties that I think we can look at there that we should learn from, right? So are these things free floating, or are they pegged? And you see that sort of thing in normal fiat currencies as well. Some currencies like to peg themselves to the dollar, some free float. And then when you peg, and this is often a hot topic around stable coins, what do you use to create that stability? What backs them up? What are they investing in? Are these new instruments created by a central entity, or are they created by a broader set? Are they decentralized in some way? Are they created by the state or a private company? There are a whole range of attributes that we can start to think about, that I think those on the right really help us bring to life when we're thinking about any new form of digital money that we wish to introduce for mass public adoption. And I think that's the key thing, right? Because what we've seen on the left, if you like, is what used to have super high usage, and that's diminished over time, as Dan was talking about. On the right-hand side, we've seen some new ideas yet to break, if you like, into that mainstream adoption, certainly in its sort of currency usage. Certainly people speculate with it. And so I think what we need to try and pick out are the best of all of these attributes to design what will actually be really useful, solving real customer pain points, and achieve that level of adoption. Dan, with a few other things you wanted to call out.
Yeah, there is. Thank you. And it's just rewinding back to that slide we talked about with marking of liabilities. So if a customer has a deposit with a bank, we mark it as a liability. And that is something that is very interesting in terms of electronic money, which is one of the new innovations that's happened over the last decade, where regulation has come in the UK through the form of EMR, where electronic money must be protected and regulated in the same way that we hold a deposit today with a bank in the form of a liability. So lots of banks, new e-money banks exist using this electronic money type license, which doesn't actually see them being regulated to lend out money. So as a result, they will need to store customers' deposits with an actual commercial bank, an entity, in order to make things protected, to make it safe, to make it regulated for the market. And what is very interesting is the publication that we saw yesterday from UK Treasury, which is that they're now willing to consider now moving stablecoins under this model, bringing it under the same principles of electronic money. So there's a very interesting article that came out yesterday. You can find it online or on the BBC or all those good sort of news article type places, which is kind of really wanting to make the UK become the hub for digital payments. So we're expecting now to see more regulation coming around stablecoins, but with regulation will bring more usage. So it will be exciting to see what happens and whether this will influence things like USDC or Tether. I guess those are questions for now, but it'd be very interesting to see what happens now in the coming sort of 12 months to the next type of horizon as we go on this evolution of money. And with that in mind,
thank you.
Sorry, Shireen.
Sorry to interrupt you again, Dan. I do have so many questions. I'm sure the audience as well. This is so interesting. And the slide that you put here is sort of summarizes really the trend that we see in the evolution of money. So interesting. I have a couple of questions here. One of them is really about the trend that you'd see in the market. So like long term, you would see only 3, 4, and 5 be available. Is that your view, or would we still have some sort of cash or anything like that in the future?
Yeah, so at the end of the day, I think it's a question of what are those key customer needs from consumers and businesses. And what we have seen in the developed world, often people talk about it as a capitalist society. What do we mean by that? Is access to capital. And access to capital has been driven by Pillar 2. So we would need to be super thoughtful. So, and remember that stat that Dan talked about earlier, Pillar 2 is providing most of the money that these businesses are accessing. If you want to, doesn't matter how good you are as a mechanic, at the end of the day, you need a garage, you need equipment in that garage, you need the ability, pneumatic lifts to lift cars up. You need a whole load of specialist electronic equipment these days to manage the EV part of the car, or indeed even on old combustion engines. There's so much electronics around. There's a lot of specialist equipment these garages need. Any type of business these days needs capital to purchase equipment to be able to execute on their business and grow the economy further. So I think Pillar 2 will continue to play a super important role. The question is, separate to that access to capital, were there clever ways that you could move money around the system? So an analogy I often use is plumbing. Plumbing is a great example of how to explain banking to non-bankers. So you've got tanks that represent balance sheets, and you've got pipes that represent the payment networks. And I think here we're talking about the pipes and the things that flow through the pipes, and are there new ways of designing that? You're still going to need some way of accessing capital, and therefore I think you'll still see more than just different forms, if you like, of 3 that will exist. Sorry, Dan, you also wanted to say.
Yeah, I just wanted to ring a little circle around the third bullet point on the commercial bank money, which is that typically today we use fractional reserve lending to lend out to the economy, that a bank holds a small amount of reserves and it can use the rest to generate lending. It can stimulate the economy and it can lend to small businesses or larger businesses or financial institutions. So when we think about that principle, you need to build a credit rating with a bank. You need to have ins and outs on your current account to show what's happening, to show your good credit rating to a bank if they want to lend to you. So I guess when we think about some of the principles and the end rights of cryptocurrency and the fact that some things can be disguised and hidden, that's one of the features that people quite like about it in terms of the revolutionary element. Then how does a bank understand what you've been spending that money on? How does it feel comfortable and safe to lend to you if it can't really see what's actually happening apart from lines on a blockchain? So I think it's an interesting thing to think about, is then connecting the two together, and how would you use that data in a meaningful way to understand more about your customer to get comfortable lending, because it could lead to instances where banks may decide not to lend to certain people or to businesses because of cryptocurrency or the volatility. They may also think that it's risky because of the nature of Bitcoin moving up and down and going through cycles. And again, they might treat that with different types of risk. So I think at the moment we're going through this phase of understanding it, and institutions are trying to wrap their heads around what's going on at the moment to really make sense of it and incorporate it into their business models. So I think this is an interesting time to be around and be working on some of these things as we decide the rules for how it will operate.
Yeah, thank you so much. I think it's a very important point, actually, that you've highlighted with the pillar 2, its importance to the economy. And as you mentioned, from a DeFi perspective, we think of all the lending protocols, the alternative lending protocols that do exist today that are based on the principles of over-collateralization. But that's completely different from what banks would actually offer you with an under-collateralized situation where they need to assess your credit risk and provide some scoring to be able to trust in that you would be paying the money back. So I think the two of them are really important, and lots of times we go really too quickly on that aspect, which is definitely very important also from an economical perspective. So thank you so much for highlighting that. Let's move on, as we don't have much time left, and would love to hear from you on CBDCs and the banking use cases you're working on.
So we'll quickly go through this, which is a nice segue for stable coins and the rise of cryptocurrency. What are central banks doing in response? Well, they're looking at central bank digital currencies. The left-hand side, you'll see, and we're looking at the UK specifically here, that cash usage has plummeted. You see a huge increase in direct debits. You've seen over lockdown and the years before that, the rise of Apple Pay and contactless type payments. You think about your coffee shops, you go in and you use iZettle or other good things to tap and go, and you can do that in the trains. Or I traveled to Birmingham this morning, tap and go on the gates, and again you're not using cash as much as you used to. And you marry that up with the right hand side, which is there's a huge rise in smartphone ownership in the UK and in general around the world over the last decade. It's gone up astronomically. So the number of people now using smartphones is going up, which allows us to then explore this notion of a CBDC, which Jehangir and I will do a double act to go through.
Yeah. So as you can tell from what I was saying earlier, one of the key attributes that I find really interesting is the fact that you can start to create, quotes, programmable money. So I can start to put within the way the payment's going to flow some more complex business logic, which can hopefully lead to some exciting use cases.
Yeah, you've also got things like instant settlement. So the previous few slides where we talked about, trapped liquidity, time for payments to happen around the world and overseas, you could unlock instantaneous settlement if you're using a blockchain and you're using this shared, infrastructure in this instance around the world. You might see instantaneous settlement for consumers, but that then ties nicely into the third point, interoperability. So this connect and work with other banks.
Yeah, so I mean, Shireen sort of talked about it a second ago, but what's really important here, and it's almost more a consideration than a characteristic, is which payment networks is it going to work with? Is it going to work with the mainstay payment networks that we have today, be they the faster payment type or the card rails, etc.? How's it going to operate alongside last decade's innovations of things like Alipay or M-Pesa? And indeed, how's it going to interoperate against some of those crypto networks I've just been talking about, where USDC and USDT exist? So the whole question about interoperability becomes quite intriguing when you decide which of those networks does it actually need to work with. So what are some of the benefits?
Yeah, so I think something that's getting people very excited is the idea that you could implement monetary policy. You could use that programmability factor to set an expiration date for money. So I think China's been testing things as their proof of concept, and as they went through the Winter Olympics around setting the expiration dates for money. You could set it at 30 days. You could ramp up the velocity of money in the economy. You could stimulate demand. You could influence inflation using a CBDC, something you probably could not do today.
And very close to my heart, we're really hoping that it can spur innovation and really help design new ways for businesses to interact and transact with one another. And we can talk about some examples later in Q&A, but yeah, sorry, Dan.
Yeah. And I think finally, just timestamping. So we talk about the benefit of blockchain having this clear audit trail of being able to see what's happening across the blockchain. And we could think about the small businesses that go through HMRC nightmares and filing tax returns and whatnot, or just looking at transactions for their own customers to perform analytics. A blockchain could tell you that. It could tell a small business, what's the busiest time of footfall during the day. They could see the amount of transactions happening throughout their day. So there's real benefits of providing a clear audit trail. And when we think about accounting as well, how many receipts do they have to reconcile and send to their accountant? Again, CBDCs could unlock many benefits for businesses and retail consumers.
So another consideration, as well as that interoperability we talked about, is actually what can you actually do? Forget interoperating. What can you actually do with today's infrastructure? So in the more developed countries, they already have pretty good, fast or real-time payment networks available to consumers and small businesses. Things like the next generation payments architecture bring with them the ability to tokenize. So already some of the benefits that people have been talking about may be able to be delivered through some of the infrastructure either already in existence or currently being rolled out. So what is that white space that we see the CBDC needing to fill?
Yeah, and going back to that previous slide again, thinking about the traditional banking model, fractional reserve lending, what happens if there's a Northern Rock style run on the banks where people move all of their deposits to a CBDC? How does then a traditional bank or a building society that lends through its deposits from its own customers, how does it then exist in this new paradigm? So could you see runs on banks via CBDCs? It's something to consider how we exist today versus then this new model. So do we cap them? Do we limit the amount of CBDC that somebody can hold? These are questions and considerations that we have.
And then finally, the example that Dan was giving around the pilots that China was running around the yuan around the time of the coronavirus and sending out their stimulus checks with their expiry dates. In some of those provinces, they didn't even need to show, forget using a bit of plastic. We all know these are now phone-based. They didn't even need to show their phone because they were using facial ID. This brings in huge questions around privacy, which different jurisdictions, different cultures will react differently to. So we really need to understand how we're going to balance the need to absolutely have the right controls in place against money laundering with the user's privacy, which equally needs to be considered.
Yeah, and I think just the final thing to add is, incentives. Do people need to be incentivized to adopt the CBDC? In China, I think there was huge incentives with people being encouraged to take it up and receive money into their accounts. So again, how do you incentivize somebody to get off today's world and move into the future? We're going to just use the last of our time and appreciate we've probably got about 15 minutes or so left just to talk about some banking use cases and what we're seeing today. So part of my role, as I mentioned, is to look at strategic partnerships and relationships. I'll go into one of those now with a company that we're working with that's called Finality. And Finality will become what we call an FMI, financial markets infrastructure. So they become regulated by the Bank of England. And they tap into this feature that we have called the omnibus account. And the omnibus account is, in its name, it's where there's a group of or a selection of funds it's all with different entities, and it's commingled into a single account. And they can use central bank money in the way that the diagram shows, that a member, in this instance Lloyds, might want to make a payment to another bank, Wells Fargo, and they tap into this omnibus account that Finality will use, which allows them to use central bank money to settle. And it's an instantaneous sort of simultaneous type mechanism which now incorporates DLT. There's a live example and diagram that articulates this quite nicely that I'll move on to just in the interest of time. But just before I do, I'll just explain why we would want to do something like this, which is exploring blockchain and DLT, because today we have fragmented and inefficient trade processes. We talked about the time that it takes to make payments overseas, the issues you might have with currency rates not potentially changing. You have liquidity constraints, and finally you have complex and costly risk management. These are all things that we experience today in the wholesale market for banking.
And isn't that worth just explaining a little bit? So what Dan's walking us through now is a slightly different type of currency play. So far, when we've talked about CBDCs, we've been talking about them in what regulators would call a retail sense. That means it's used by consumers and businesses. Whereas what we're looking at here, where we're starting to see a lot of attraction already, and you'll see some of the examples in a second, is what we call wholesale, which actually means sort of bank-to-bank currency. So the sort of processing that they do in the background on our behalf when we're trying to transact. When Sainsbury's in the UK is trying to pay, say, Unilever's Dutch operation, how does that actually operate, and how do we do that in an effective way? And that's the types of solutions that Dan's looking at here. How do the banks in the background actually make these things far more efficient than they were?
That's a great point to call out. That this is specifically looking at wholesale. So those things at the top is what we experience today when we're making payments on behalf of clients or paying bank to bank. But finality is a blockchain which becomes a financial markets infrastructure. It becomes a payment rail, and it has 5 of these really fantastic characteristics that it's allowing to challenge and kind of solve for the above issues, which is 1, having programmable cash that we've talked about before, the smart contract type features that Solidity offers in blockchain that can be deployed to do certain conditions that are met, such as earmarking of funds. The high quality liquid asset characteristics is the previous slide, that it leverages the omnibus account, which is tapping into central bank money. So it means that it's readily available. If somebody wants their money, they can get it on demand, they can get it instantaneous, which is why we look to regulate these entities. And then we've seen it with electronic money and other things, that they're regulated, so they're high quality liquid assets, so customers can safely get their money quickly and surely. But other characteristics that finality will have is that it's instant, it's atomic settlement. So the settlement will happen in seconds. It's this instantaneous exchange between the 2 entities, and it's 24/7. So these payments can be made outside of RTGS, the operating hours that you'll see of 8 till 6. So it can happen outside of that time period too, but you just wouldn't be able to withdraw that money. And finally, it's interoperable. So it can operate with other DLT type platforms. So finality today will enable bank-to-bank payments, but it can interoperate with different blockchains. So another blockchain might exchange securities. So you could swap securities between banks, and then using finality, you could make payments between banks. So putting 2 and 2 together, you then created things like repo that exist today. You've got other use cases that could exist that I think Jehangir will elaborate in the next couple of slides, but it really brings more and more features as you add this element of interoperability to the equation. So let's just quickly go through this diagram. It looks like it's pixelated slightly on my screen, but hopefully we can still articulate the message. So the omnibus account is the step 1 that happens in this scenario. So Lloyds tops up and sends £10 to its omnibus account, and finality is able to match that 1-for-1 digitally. So it creates a digital representation of Lloyds's money onto its blockchain. We then use the existing system today, Swift, which allows bank messaging to take place. So we send a message to the blockchain to instruct that our £10 is now going to be sent to BNY Mellon, who will be the second participant bank. That money happens instantaneous because the blockchain has that feature and that characteristic. So it debits Lloyds Banking Group £10 on the blockchain, and it credits Bank of New York instantaneously. It then taps into the Swift messaging network as it does today, and it sends an MT message which then says reconciliation is happening. So we are able to do all of the credits and the debits and the reconciliation of our bank ledgers internally. And then the blockchain, as you'll see on the right-hand side, works in that 5-step type fashion of the block is created, the nodes are validated when the communication has gone out, when they've reached consensus, they write the block and the blockchain is updated. This is where we'll get to in terms of a new bank process, which then can potentially unlock more and more use cases that I'll move on to, or Jehangir will move on to.
Yeah, so in looking at how we can use this type of new tokenized money, we looked at a range of different possible situations, and what kept coming up were actually quite often complex lending situations where you're not just doing a simple overdraft or unsecured loan, but maybe doing some asset finance, a mortgage, a syndicated loan, which is the example we ended up taking, where actually a business may need a really, really big loan, which means that rather than coming from just one single bank, it actually comes from multiple banks. Maybe you're buying a fleet of aircraft or a big set of trains for your national rail service. So in these situations, you actually have multiple banks providing the syndicate. So we move on to the next page. What we started to look at with this tokenization is actually, how can I start to do something interesting and novel with it? So if you imagine for a moment that you have provided a loan, which means you're if you're doing all this, say in a think crypto for a moment, if you want to make it easy in your head, you've actually issued all your tokens to the platform. The platform's given it to the borrower. You may get back some receipt tokens. How can I bundle these receipt tokens and create potential securities? Because these receipts are IOUs. Someone's going to be paying me interest, and therefore I've got an income stream coming, and I can do something with that. So if we move on to the next page, and apologies if I'm sort of rattling through this a little quickly, I'm sort of noting time. I wanted to talk about some of the potential benefits that we're seeing. So one of the key benefits we're seeing in these sorts of complex cases, and more importantly, in situations where you want multiple parties, actually, you can start to create these kind of marketplace businesses or platform businesses, because you can standardize how things work and bring together business processes that you've codified essentially on chain. Equally importantly, we started to investigate how we could get some of that off-chain data and interrogate that in ways that was still privacy preserving. So that may be contracts or covenants associated with that loan, or the collateral, such as the trains themselves or the property, etc. And how could I actually use that within the smart contract execution? And then in that previous page I showed you with the use of creating potentially securities, is how can I do some balance sheet management? Again, importantly, we're talking about the role that commercial banks have to providing capital. One of the things they're therefore very thoughtful about is how to keep their own balance sheet very healthy. And so we often do quite active balance sheet management. And again, this tokenization can work quite well with sort of current or slightly redefined securitization processes that can, again, be really helpful and fruitful.
So I think we're going to end on a video, and I think we're going to hand back to Shireen for that.
Lloyds Banking Group has over 25 million customers in the UK. Choosing which of their needs to serve is surprisingly complex. Each bank decides based on their own constraints, which means some customers miss out. Across our retail, commercial, and insurance businesses, we miss out on serving many of those customer needs. This is because the way we operate is binary and exclusive, so customers are either in or out. We focus inwards, following restrictive rules aimed at protecting ourselves and our customers. Our manual high-value work and some regulations constrain our bandwidth. What if we could remove these constraints? Imagine if there was a more open and collaborative way to bank. If we could be involved to varying degrees in many more things. If we thought about trust differently and found ways to sense the external world better. For example, In complex lending, we could syndicate loans of all sizes, bringing new borrowers together with new types of lenders, like cash-rich companies or investors. When managing risk portfolios, we could represent our assets as tokens that would give us flexibility to split and bundle them up in transparent and traceable ways. And in mortgage lending, we could bring flexibility to the home buyer's deposit and alternative financing structures for the loan we provide them. By exploring the emerging capabilities we need for the future, we seek to unlock a 10x improvement in meeting the varied needs of our customers.
Yeah, that was a great video. Thank you so much, and a great presentation. It's really inspiring to see all the use cases that you've gone through. So beyond really everything that we see out there, even about CBDCs, but really taking it into the syndicated lending space, and then all the innovations that can happen on the home buying space as well. And there, I had actually a question for you. And at what time horizon do you see all of these innovations coming? I know you're probably working already on this syndicated lending project. Is it close to being launched in the market?
So it's very early stages at the moment. It was as much to help us understand exactly how this technology will bring benefits to our processes and eventually essentially to our customers. So it was enabling us to get hands-on with some actual EVM compatible smart contracts, rather than actually getting to that point of testing product market fit.
And I think it's
Thank
like
you.
video.
That's definitely promising. Sorry,
like
Dan, please go ahead.
It's like the video that Jehangir shares at the moment. It's storytelling as well. We're communicating to the rest of the bank. This is the future. This is what's happening, and here's what you can do. And I think there's a real kind of journey that we're going on, which is to explain what characteristics, what features, what benefits this could unlock.
Yeah, absolutely. Sounds really amazing. So thank you so much for sharing these use cases and examples. If anyone watching us live would like to ask any questions, please post these on YouTube and LinkedIn. And meanwhile, do you want to take us quickly through some of the use cases that you would like the hackathon participants to work on?
Yeah, so I'll bring my screen back. We've been working with a colleague who's unfortunately on annual leave today that's designed some fantastic use cases that we're throwing out to the hackers, which is around one NF tree. So can hackers create a DLT platform that manages the status of a woodland by creating an NFT that represents the age, location, and health of each tree? These would get burnt if a tree dies or gets felled. The second is Mr. Bonds. So we're seeing huge ESG growth year on year at the moment across banking. ESG bonds are something that are timely to track. They require complex manual processes that involve various data methodologies and checking regulatory changes, and are companies complying with that? So another use case is how can we successfully leverage DLT to more efficiently initiate, construct, and service ESG-linked digital products? And then finally, mortgage. So how can we create a fractionable token that can be used to help disperse assets to somebody who's recently deceased or to different beneficiaries automatically, almost self-executing their own will of sorts? So these are some things that Lloyds are very interested in exploring. And if any hackers have got the interest of taking this up, please stay in touch. We'd love to hear about it as you go along the hackathon over the next couple of days.
Yeah, thank you so much for sharing these. So if for everyone and anyone interested, you can find these use cases on fintech.devpost.com. We do have an ideas tab where you can explore different problem statements and ideas submitted by Lloyds Bank and other parts as well. We're also happy to support with any questions you might have on the Hackathon Discord channel. So first thing you need to do is to register on fintech.devpost.com, and then you'll get access to all of these support resources. With that being said, I don't see any other questions. So, and we're already on time. So thank you so much, Dan and Jehangir, for a very interesting session. I found it really inspiring, both to learn about these quite complex topics of blockchain, CBDCs, and then its use in the commercial banking space. So it was really interesting to see some practical use cases that you are working on, and as well that the hackathon participants can work on. So thank you so much for this. I really enjoyed the session today.
Yeah, thank you for the questions, and really glad it was engaging for you.
Yeah, thank you so much. Thanks for everyone watching us. There's definitely more. We are on the last week of the hackathon, so looking forward to our upcoming sessions and to connecting with all the hackathon participants on DevPost and also on Discord. Thank you so much again, Dan and Jehangir. Really loved the conversation today. Thanks everyone watching us.
Thanks.
Cheers. Thanks everyone.
Cheers. Bye.